Update from last week. So just a normal housekeeping, these are recorded online, so you will be able to visit our website and review it afterwards, or share it with anyone you'd like. Or if we've noticed from last week, a few people, the sound wasn't 100% clear on their end. It could be just the speed of Wi-Fi, but the recording seemed to be going through clearly, so feel free to play back any parts that you might have missed. So today we're going to catch up a bit on what's been going on. As last week, we do have the Q&A. I have Sophia is online helping with Q&A this week. So the toolbar is a little bit different from last time, but the premise is the same. So you should have a little tab that you can type in a question. We'll monitor those and answer them. If appropriately on the fly, we will. If not, we will do them at the end and just deal with any other topics that might come up throughout the session or that you might have. Just before we get started, for those of you who are new with us here, my name is Michael LeBlanc. I'm the Director and Portfolio Manager at Canaccord Genuity Wealth Management. We're going to just go through what's going on with the world. So obviously, the markets have been a bit of turmoil. Last week, we covered most of these topics. This is what we're looking for. As we mentioned, markets don't like uncertainty for the most part. And we've got the COVID outbreak. So the COVID has thrown the markets, I won't say off their normal cycles, just accelerated the cycle. And we're really waiting to get a handle on when this is going to be going to get caught up with the world. And mostly we're looking at the US. We've seen China go through it, although the numbers are in question, but they seem to be coming out the other end as they reopen businesses. We have Italy and Spain in the middle of a peak of a curve. Canada, of course, is working very diligently to try to flatten the curve, which is why we're all working at home. And thank you very much for everyone who is staying home and helping with that effort. My team is all at home. As you can tell from this, I'm working from home. Hopefully the pictures and everything are coming through clearly. My son's been helping me with the setup. I have both my boys home, although he said if I want to continue to do these, I'll need a better camera. And then he commented after seeing a practice that maybe I don't want a better camera. So, you know, kids are great. So happy to have them home here with us. But what we're really watching as far as the COVID is the US numbers. We're really watching that curve. And I'm going to show you some numbers here today and just see how they're going to approach it, whether it's going to be Italy-Spain model or more along the lines of what we've seen in some other countries like South Korea, where they've managed to flatten the curve. And by flatten the curve, we do not mean less infections. Flatten the curve does not mean necessarily less infections. It just means slowing the rate at which it spreads in an effort to minimize the impact on the hospitals, not overwhelm the hospitals, not overwhelm the healthcare system. And this is really to ensure that people can get the care, which makes the survival rate much, much higher. And we've seen that in different areas when it does overwhelm, such as Italy, the death rates are much higher than we've seen in other areas that have managed to flatten that curve. Spain is now approaching those levels. And some areas in the US already, New York being an example, where they've had to set up makeshift hospitals in Central Park and makeshift facilities to deal with the volume of people seeking help. Fiscal and monetary clarity, we touched on it a bit last week. Of course, last Friday, we did get the US package, the $2 trillion stimulus package, approved through the governments. Canada has been rolling theirs out on an ongoing basis. We seem to have developments continuously. On the Canadian front, there's been a lot of changes, not just provincially, but federally, with the subsidies for people affected both from an income, but also housing, mortgages, and so forth. We just sent out today I would say detailed list of all the different things Canada is doing and what may or may not apply to you. So if you haven't seen that yet, do check your inboxes. You should see that today. Obviously, it's changing on the fly, so we'll try to keep the information as current as possible. That information we put out today was based on Friday's information, and I know Trudeau's coming out every morning with some slight changes as they implement these things. So we'll try to keep everybody up to date. If you did not receive it and you would like to get some information, just put in the question, just type you'd like to receive that summary, and Sophia will make sure that that goes out to you right away. She just put in your email address in the question and she'll make sure that she sends it off to you right away. Vaccines or treatments, as we touched on last week, a lot of testing in process. The vaccine is obviously the longer term solution. The treatment, however, there are a lot of currently approved medications that are being tested. They're mostly centered around the types of medications that reduce inflammation, especially in the lung area, because that's where COVID attacks. So those are like malaria medications and also gout medications. I know there's been some talk on social media on which ones are working, which ones are not. They're all in testing phases against the coronavirus. There's no real winner there yet, but there are several. I think the last count I saw, there's about 5 different ones that are being phase 3 tested. And these, again, are drugs that are approved for other illnesses that they know the side effects. They just need to see how effective they are against the coronavirus's impact on your body. So this is a chart we track every day. I cut it off. It goes to the whole world. I cut it off at Canada. So this is ranked by the countries, total number of cases. As you can see, the U.S. up there. This is from this morning. This is from roughly a couple of hours ago. And I checked it just before we went live here. We are through 835,000 in the world. So we've already jumped another 10,000, and the U.S. is through 180 already. So the numbers are moving very quickly. Again, the real thing we're watching for around the world today is that U.S. curve. How effective will they be at keeping the death rate low? Not necessarily the infection rate. The infection rate is pretty much a pre-gone conclusion that it's going to be massively spread in the U.S., but it's the death rate. Will their healthcare system be able to keep them at the 1 to 2% death rate to infected versus what you can see easily here? Italy's through 10% death rate on the infected, and Spain is climbing very quickly to double digits in that area. So that's something that we're keeping a very close eye on, and will be an indicator for a lot of what we recommend as far as the markets go. And here's the numbers you see there. Again, just those I see by my screen here, a bunch of people jumped on a little bit later, but if you want to ask questions, by all means, you have the Q&A buttons on your toolbar there. You can just type in your questions, and we'll try to keep on top of those. So where are we today in the global markets? So just to look back on last week, we did have a rally last week that was not unexpected. If you were on our last Tuesday cast, we did say we were expecting that. We call that the false rally or the dead cat bounce, but I'll get more into that. But what we saw last week, Monday to Thursday, Friday was a negative day. Right at the end of the day, the day went negative because Congress was delaying that the $2 trillion bill that the U.S. was trying to put through. That went through, so of course we've seen a positive day yesterday as well. Mostly in the U.S. Canada was a bit positive yesterday, not overly so. And just before I started this, the U.S. was just negative today, not overly dramatically negative, and Canada was positive by a couple percent. It was bouncing around a little bit between 2 and 3% positive today. Started off better this morning, pulling back a little bit in the afternoon. Before I get into kind of what we see or what we get out of this rally, But I broke it down by sector here, so you can see utilities, industrials, REITs, energy a bit surprising because oil is still staying low. But we did see it jump up off the bottoms. Financials, not a big jump. Consumer discretionary is a bigger jump than maybe expected, and technology as well. The underperforming sectors, communication services, consumer staples is surprising. Consumer staples is kind of like your grocery store areas. That should have a stronger bump, but they tend to be what we call the non-sexy sectors. So it takes people a little while to start tracking those as they see more and more value. Healthcare, obviously a lot of money flowing into healthcare right now is bounced up, and materials. We mentioned just on the side, gold was down, up, but moderately compared to the market. The dollar, the US dollar is down a little bit. Gold, we mentioned it's not, in these types of crises, gold does not act as the hedge it should, meaning markets go down, gold goes up. And we're definitely seeing that right now with a flight to the US dollar for safety. And as I mentioned, oil falling down again, the 5th straight week, another 5%. We'll get more into that as well. U.S. equities, as mentioned, rallied more last week versus the fall off. And I do apologize if I'm jumping through these slides a little bit. If you'd like copies of these, again, just put in the questions. Sophia will get them out to you. Information is coming through at a dramatically fast rate. So I am throwing these, trying to throw these together, not at the last minute, but obviously with the most current information. So I'm putting a lot of information on the slide, but I'm going to talk to the high level of the topic. But if you want the detailed numbers in here, by all means, do reach out and we'll get those copies to you. You can read through. As was mentioned, the U.S. we had the rally last week. We're really looking at the momentum from this quantitative easing from the governments. Donald Trump was pushing last week for a quicker open to the economy. Obviously, he's delayed that with the new numbers coming out of the U.S. He's gone to April 30th now. Originally, he was looking at Easter. So that's been delayed till at least the 30th. I've talked about Italy and Spain. Spain being the one ramping up a lot faster, catching up with Italy. And everyone's trying really hard. We're seeing a massive amount of claims in the U.S. We're seeing the insurance companies in the U.S. Starting to waive copay and pay for the treatment for COVID down there. And of course, unemployment is massively increasing in the U.S. as well. So just overall markets for last week, you can see the TSX, the top line there, up 9%, and the S&P 500 also up just over 9%. Still down, obviously, on the month and year to date from the previous weeks of decline, but it just gives you an overall view. What I really wanted to look at is this, as I mentioned, by sector. What we talked about last week, where we were expecting that bounce, that false bounce, that false rally. This really speaks to it, because if you look at the sectors that come up, the top one here, energy, with oil down 5% last week and it rallying into that. That means what we're seeing is people buying on speculation. They're not buying on value. They're not buying on economics. We also saw that in technology had a jump. And this is broad technology, not necessarily just these webcast things. We saw consumer discretion have a very large bounce. Whoa, sorry. Apologize. Let me get back to where we were. There we are. Sorry, the consumer discretionaries jump. Again, consumer discretionaries are the ones that are going to be hit the most. Consumer discretionaries are things that we don't necessarily need. So not the grocery stores, more like your restaurants, luxury items. And we know that, the department stores, and we know those supply chains are all closed. And even if they were to open sooner than later, like Trump was saying last week, it's still going to take time to reignite that supply chain. So for them to be jumping by that much, even off lows, on the positive of that, that means those lows that we hit the week before, are kind of that oversold. The market sees that as oversold, too cheap for what's going on in the world. But at the same time, that those areas jumped that much that quick is also telling us that people are speculating, or buyers are speculating, that that's not going to be based on actual economics, meaning the companies that are actually going to revitalize out of this the quickest and also the most profitable, where we'd see those more in your consumer staples, where people are buying groceries and so forth. As I mentioned, we do see this relief rally as a normal bounce. We do expect it to pull back, but it is a very good sign that we may have reached. When we say bottom, means kind of the lower end, does not mean that we're not going to revisit that. In fact, it's very, very, very likely we will come close to that again, and we may break through that bottom if we see more panic, if the U.S. does follow that kind of Italy model. But this bounce, or this relief rally, does bode well that the market basically, the sellers basically said, this is too low, I don't want to sell at that level, I'd rather just hold. So the selling slowed down, and the buyers said, this is too cheap, I'm going to start buying. We're not recommending people jump in on that right away. I still recommend patience. We should retest, or at least come closer again to that bottom, even if things are getting better before this is over. So there will be that buying opportunity. And that second pullback, if we do not break through that bottom, will give us a lot more confidence that that is the absolutely kind of oversold bottom that this market sees as far as value goes, given what's going on in the world. We want to, as I mentioned, we want to see that pullback. We should see that pullback at least within 5% of that bottom to really appreciate that we might have at least seen the lows of this crisis, and be an opportunity to start moving back in. Doesn't mean that we're looking to jump back in with both feet, just means we'll start moving into the markets in different areas, and we'll touch a bit more on those areas as we go through here. We do want to see volatility slow down below its peak. We're not there yet. Credit, I mentioned last week, the big thing when we look at the companies going into this is to be able to maintain credit levels, because what happens in these crises is the credit market. So there's two credit markets. There's the banks who loan, and then of course the open market, bonds and debentures. What we see happening, and we have seen that happening, is the credit market tightens in the open market. That means volumes go away. So you could have a very good company with really solid cash flow, has always paid their bills. Cash flow might be still continuing, but no one wants to own their debt. So it just sits there, and they can't sell more. So if they need to renew that debt, or if they need to finance something new, they can't get access to money. And of course, the banks are battling liquidity, which is why the interest rates have been cut so low, is to give liquidity to the banks, much like we saw in 2008, 2009. But we have to really watch those companies, because a healthy company can be brought down by their inability to refinance even existing debt. So when we say we wade back in, we really want to make sure that we can see that the credit is being maintained, even expanded, so people are able to finance some during the crisis. Certainly the higher quality ones, at least. The lower quality ones are going to be very, very risky for the next while. Again, even if it's a great business plan and have solid cash flow, it's going to be difficult to get financing, or more specifically, refinance existing debt. So if they have debt coming due, think of it as a mortgage. If your mortgage is due and the bank says we're not relending and you just have to pay us back, and you don't have that, or you can't get it from any other lender, then that's when the trouble starts. And then we want to see better market internals during the panic phase, and that's that test in the bottom that we're looking for. And we call it a V rally because we do expect certain sectors to bounce back very quickly when there's a little bit of light to the end of this crisis. So where do we see the opportunities here in this volatility? Well, first, opportunities are stay the course. So this graph, we went into much more detail last week. That is on our website if you want to go look at it. But just the value of staying the course means not getting out. So this just shows three options. You know, the cash line, you go to cash, you miss the rally, you don't bounce back. You can go to bonds, but they're very, very lows. In fact, we're almost in an inverted curve here. So interest rates are extremely low right now for quality debt, and it misses a lot of the bounce as well. So staying in to your risk profile, again, don't downgrade, might not necessarily want to upgrade your risk profile, but just sticking with your profile and sticking with quality. That does not mean necessarily holding everything you hold today. The best advice I can give you to there is really look at the portfolio and make sure what you have is what you want to have, what you want to own coming out of this crisis, what companies are going to have the strongest earnings, what companies are going to be able to reignite the revenues the quickest, and which ones people are going to favor. I have gotten a lot more questions about the airlines. I know we talked about it a bit last time. They have bounced up in this rally as well. However, I still hold that they're very, very risky speculations to go into. As I mentioned last week, they don't own any debt. They don't own any assets. They just have their leases on their planes. So they're very cash flow driven. So interruption to that cash flow, they can go into restructuring very quickly. We usually call it bankruptcy, but it's actually not. It's pre-bankruptcy. It's a debt restructuring, and that enables them to take away all the value from the shareholders and give it to the debt holders. So it's very, very risky sector to wade into, because it's not only the crisis being over, but people have to start flying again or traveling again, and that would be for your cruise ship companies, etc. People have to start using it again, and we don't know. We have no data around that as to how long it will take for people to regain confidence in travel and spending in those luxury areas. So that being said, we were in a economic cycle prior to this happening. In fact, our portfolios were geared for a recession going into this, which is helping us a lot. We have a lot of those good companies. We have a lot of cash on hand, and we can't forget that cycle is still there, because when the COVID crisis ends or starts to unwind, that's what we're going to be looking at. What's going to be doing well coming out of this? So that mini cycle was definitely interrupted, but it's still there, and we still have to be very, very aware of where things are landed. And what we were seeing going into early February was a lot of crisis around borders. We had the Middle East. Of course, we still had the U.S.-China trade situation, although it was improving a little bit, or at least there was talk of it improving a little bit. But that has all changed now. We still see the second half of this year as being the timing for a solid recovery. And that's based on all the fiscal stimulus we're seeing out there, and basically the world going into a recession. Because we can't say an official recession because you need 2 quarters of negative GDP growth, but and you can only say that after you've done it. But I mean, definitely we are in negative GDP growth around the world for most countries right now. So we do see that we're very likely in a recession. Pretty much most countries around the world, but we are seeing a lot of stimulus going in to bring us out of that fairly quickly. So going back to what we see in the underlying economy, the economic impact is going to change a lot of areas. Certainly not on the trade front. I mean, I think those areas are probably going to be a little more strained going through this, especially with U.S.-China. We have to restart that distribution chain. So the goods flowing back to the stores when things start to open. And that's going to be difficult. We've got, the strained relations with China, and that's a lot where goods come from, obviously. And also the restarting, and not to mention raw materials, getting back into the supply chain. Central banks have limited firepower left because they have cut rates so much. Canada doing its second cut, of course, this week. So most of the global central banks have cut to near zero levels. So they're now fairly limited for anything going forward. We also have a U.S. election coming up. It has shifted the map quite a bit when we look at the Democratic side. Obviously, Bernie Sanders, who had some strength going into January and early February, has lost a lot of that given the crisis. It's definitely, people are seeing a favored Biden-Trump duel for the election. And that being said, both would be a fairly neutral impact on the market. So the Bernie Sanders kind of candidacy here is probably not what people will lean to, just because the monetary cost and changes that they would have to deal with in his platform. Canada dealing with a lot, because we were actually poised to do fairly well economically this year, despite the US, Germany, and other countries potentially sliding into a recession. But this oil collapse is really going to impact on Canada. A lot of our industry is geared around the oil sector or energy sector. Alberta is going to feel a massive brunt from this. And we're already seeing the cuts and layoffs and news from there. I don't think that's going to be short-lived. So Canada is going to have to battle that a little bit harder than the rest of the world. We've actually seen Canada underperform global equities in this downturn because of that. And we probably will see that continue. So a lot of what we're going to talk about as opportunities is not necessarily going to be in the Canadian markets. We will see some in the US, but some on the global front. I get a lot of questions about the Canadian dollar and the exchange rate. So we're forecasting with the recent cut we've had in Canada, kind of 71 to 77 cents. And we did climb up here a bit. We're over 70 again. We were kind of 69. The kind of 1 year forecast is all forecasts implies is closer to 80 cents. And that's pricing in a U.S. recession. One of the ways that incredibly is very accurate, if you look at it historically, for pricing where the currency is going to go, is the Big Mac theory. This was developed in the I believe in the 80s, 70s, 80s, by an economist out of the U.S. And it's basically, it's a very simple calculation anyone can do. It's you just take the price of a burger in Canada, or a Big Mac in Canada in Canadian dollars, versus the price of a Big Mac in the US in US dollars, and you divide it. And if what you get is a rate or a ratio that is very similar to the currency rate, then the currency is trading relatively where it should be. If it's higher or lower, then it should trend towards the Big Mac rate or the Big Mac ratio. And right now the Big Mac ratio is about 1.15, so closer to that 0.8 is where it should trend to. So if that gives you any forecast on the Canadian dollar going forward, enjoy that. Believe me, the first time I heard it about 20 years ago, I thought that the economist was crazy, and it was dead on within 12 months. So it does tend to trend those ways. I don't know if I would call it on the spot, but it does tend to trend based on what actual currency exchange or spending power leads to, and that should trend there as U.S. dollar weakens as they come out of this crisis and into a recession. So what do we see around the world? As I mentioned already, we talked a lot about the U.S. The recession's very likely there. They're doing a lot of easing to try to reignite the economy. But the big thing we're watching is the COVID outbreak and how serious that gets in the U.S. They're still not quite at a predictable area. The Eurozone It's actually one of the worst affected, because if you really look at it, as most of you would have heard me last year saying, we were kind of watching Germany very closely for a recession. They've obviously increased a lot of government spending, racking up to government debt. But with France already having troubles with their taxation changes that they put in place, they were having riots and demonstrations going into this. But then you throw Italy and Spain into their crisis right now, it's going to have a very big impact in the Eurozone. So we're kind of bullish moving back into the Eurozone just yet. Obviously, while we look at that impact, will be a longer climb out as we go through. The UK, actually one of our more favored spots. Unlike the EU, who has to kind of react with their monetary policies that represents all the countries, the UK, because of Brexit, are able to act on their own, and they have been able to cut their interest rates. They have been able to increase monetary spending and put them in a slightly better fiscal position. Also, they haven't fallen as much, mainly because they've been suffering for the last few years on getting to Brexit, and they're still not all the way through. So they do have an opportunity to climb a bit faster than we might see, certainly in the general European Union. Japan, again, doesn't have many arrows in its quiver. It was already dealing with a VAT tax issue in October. They've had natural disaster issues in the last half of the century. COVID, not as big impact there, but certainly pushing them into a recession. And the Bank of Japan has limited firepower as well, just due to previous cuts that they had made to deal with other crises. China, obviously, big impact. The frequency in cases that they're reporting are slowing, but we are seeing them turn around as far as opening things up again. We're seeing normal levels in coal consumption and power generation trending back to normal levels. The infrastructure projects are starting to fire back up again. They have cut interest rates. So that's one to watch. It is difficult, as you may have read or seen. Some of the numbers coming out of there aren't matching up to observations, but we're keeping a very close eye. Australia and New Zealand, they tend to be a mini Canada. I don't mean that in a derogatory way, just economy's a bit smaller, but they're also a natural resource producing countries. So they're very similar to Canada. They're being hit very hard from the oil crisis. They've cut their rates again to ease, and they've seen very similar impacts that we've seen here in Canada. So where do we see things moving ahead? Obviously, the equity markets are the best areas that we're looking for. And with, as I mentioned, the UK being one of the areas that we find the most attractive. Eurozone is going to have a very attractive value, but keep in mind probably a little bit more volatile for a longer period of time. Once we see the established markets, the North American markets, the UK market start to revive, do look for the European market, emerging markets to follow. They will benefit from the supply chain reopening. So it's something to keep a close eye on as well. High yield credit can also be an area of attraction to get back into the market. These are those debts of quality companies that have gone down in value, mostly due to lack of volume. We saw this very prominently in 2008, where debt, which usually trades per $100, so bonds trade per $100 in value, go down to $80 on very quality. Things like TELUS were in the 80, 85 range. I think they even touched into $75 range here in Canada. But globally, we saw just lack of buying volume drive the prices way down. Again, a lot of research has to be put into those opportunities in the sense of when do other debts for that company renew? Are they going to have trouble refinancing, or are they all their debt long enough out that it's not a concern? So that is an area that we could see a very quick snapback in high yield corporate debt, and that's what we refer to when we say high yield is corporate debt, not government. Our main expectations in currency is we will continue to see the US dollar be the safe haven, but it should unwind as we come out of the the virus crisis and we go back to normal economics. And that's where we should see the Canadian dollar improve, and the British pound as well. And as I mentioned, the Australian dollar, which tends to mimic ours a bit just due to the commodity connection. I've had a lot of questions about ideas of what to buy. By no means is this list a recommendation to go buy straight out. One, not all these sectors are current recommendations, but I do like to always give recommendations across all sectors. And two, we're not necessarily recommended to buy right now. Those of you who have portfolios with us will notice that a lot of names are already currently in the portfolio, so we might be adding more to those as we see really good value. But on the energy front, TransCanada Pipeline and Enbridge, the pipelines were hit very, very hard in the oil fall. But keep in mind that they don't produce oil, they just pump it. So it's really on supply and demand. So as the supply chains increase again and more oil starts to flow through, they will rebound very quickly. They also pay very healthy dividends. TransCanada Pipeline announced this morning that they're going ahead with the Keystone Pipeline project. So, you know, business as normal for most of them. So it's a good area to look at. Materials, gold, Franco-Nevada and Barrick Gold are probably, you know, an individual name basis if you wanted to do the gold play. Again, I'm not a huge fan of that right now, but there's also exchange traded funds that you can buy in that front that give you a broader exposure than just an individual name if you wanted to play that. Industrials, Waste Connections has been in our portfolios for a while, and CN Rail as well, that we both like them. Great cash flows. Waste Connections is going to continue. Revenue-wise isn't going to be interrupted, so there'll be a quick rebound. CN Rail, as the supply chain increases and as it continues right now, getting goods to replace everything in the shelves across the market, will continue to do well. So we do recommend that. Dollarama, always a good recession play for retail. It tends to do quite well as people shop for better deals. Warren Buffett, I think, was the one that said that he drives out to Walmart and Dollarama and counts how many Mercedes are in the parking lot. And the more Mercedes, the more he thinks, you know, recession is not recovering anytime soon, and the fewer Mercedes, then it's starting to get better. So just keep that in mind as a value play. The consumer staples, Metro, which is grocery stores in the East, and Couche-Tard, we already have in our portfolios as also grocery stores in the East. Both are great values. Both are very good contenders to do well. The other one that falls into that group is Loblaws. Also like Loblaws, but I think from a debt, dividend, cash flow perspective, these two are a bit better value. Financials, Brookfield Asset Management, more your infrastructure financials, but we do like it. It is in our portfolios currently, and it will continue to do quite well. And then if you want to buy the Canadian banks, which do represent a good value, they have pulled back. The dividends are strong. Of course, Royal Bank being our largest is an easy pick. If you wanted to go value, TD would be your other one to consider. Technology, Constellation Software is kind of a grouping of companies. It's very good value, good cash flow, healthy balance sheets, and Shopify. Although I still find Shopify fairly expensive. If you're looking to capitalize on the online shopping, it's one to consider. TELUS and BC on your telecoms, both great dividend payers, great infrastructure. They were early build to technology, both for fiber optics, which is being used massively right now, obviously, and 5G, which is coming out soon. As people stay home, we're really relying on these types of infrastructure. In fact, it'll be interesting to see if those types of telecoms don't become utilities in the near future. Utilities, Hydro, Fortis. Also really like, if you're looking for a more mid-cap play, Algonquin Power, which is in our portfolios out of Ontario. Great cash flows, low debt, good producers. If you're looking to play the real estate market, which I'd be cautious about, just because, yes, interest rates are low and that could be a bump, but at the same time, we don't know how the job market's going to fare out of this. The unemployment rates are skyrocketing. Some predictions could be 20 to 30% unemployment, probably more along the 10 to 20% for a temporary time period. But I'm not supposed to touch my face, sorry. But do keep in mind, if you are looking at that, Canadian real estate properties, as far as debt goes and cash flow, is one of our favorites. On the US side, Lockheed Martin and Waste Management, both doing well through this. Again, Lockheed's probably, it looks, the balance sheets look strong, the cash flows look strong, but it's not an industry I would jump on right away. Waste Management, definitely. Consumer discretion, Amazon, so the online shopping, of course, and Home Depot. A lot of people are taking advantage of this downtime or home time to do things around the house. My kids and I, when it's not raining out, have started a shed project in the back. So we try to get out every few days for a couple hours in the late afternoons to work on that and get some fresh air. Consumer discretion is Procter & Gamble. I love it's in our portfolios already. We probably add some more. Coca-Cola is another one to consider, kind of that comfort food, mass distribution side of things. Healthcare, J&J, very diversified, everything from soaps to medicines. It is in our portfolios. We do like it. United Health in the US, also a good one. For your value financial play, Berkshire Hathaway is good. And then technology, Apple and Microsoft, both very mature companies, both going to be able to take advantage of people staying at home and being online more. Another one that comes up in technology is Zoom, which is what we're broadcasting on right now. It has done well through this. It's actually rallied because schools and companies and individuals have been signing up for it dramatically. But it is a month-to-month subscription, so as the virus winds down, we are cautious about the value on it because people can just cancel the subscriptions and go back to normal afterwards. So be cautious on that. The other two that fall under technology that I don't have on here that I do really love, and if you want to take a side play to people shopping online more or not even wanting to touch or use cash in the grocery stores, are Visa and MasterCard. They do not own their debt. I always tell people this. They own zero debt. The bank that issues the card owns the debt. So it's not about people paying. It's about people using it. They get paid as you tap on the card. There is some push for the governments and the credit card companies to drop interest rates. But again, that goes to the banks. That's covering the debt. So those are two really good plays that have been in our portfolios for quite some time, and they've been amazing performers and very, very, very strong cash flow producers. Utilities in the U.S., NextEra and Real Estate American Towers. American Towers are your cell towers, and Crown Castle. So, so you know, as we move on the real estate front, we're avoiding the strip malls and the department stores, retail space, basically. And that's because we don't know what the fallout of the supply chain shakeup is going to be. As people, we've already seen a trend going into this of more and more people using online shopping like the Amazons and Shopify's of the world. How much more is that going to continue? And how much more store closures will that happen? We've already seen some complete closures here in Canada. The Steve Nash Fitness World gyms have closed their doors permanently. So all that real estate is coming free, and it's going to be tough to lease back out again. So I would caution you on those fronts. One thing that comes out in these markets that I always caution people about, it's an area that I won't say I don't like these. So this is not a recommendation. This is actually a caution. Is what we call principal protected notes in the industry, and a lot of different banks issue these. Some private firms issue them, and these are the notes that basically say, the first one here is the banks, which is an auto callable. So they go by the top 5 big banks. And it's a 5-year note, 7-year note, and in 7 years you're kind of guaranteed your principal, or as long as it doesn't go below a certain level or above a certain level, you're guaranteed. If it breaks through a certain level on the downside, then you get the full market hit. If it goes too high, they'll call it back and give you your profit to that point, but they'll call it back. And you get that return up until that point. Some of them are straight, like the bottom one there. It's a GIC, so you get your principal is 100% protected, but your rate of return is unknown based on what you buy, but usually have caps. I do not like these for most people. I caution, they tend to come out in the woodwork at times of volatility because they sound very appealing. The guarantee sounds appealing. But what ultimately ends up happening to the broad market, again, this is not for all of them. Some of them have worked out well, but to the broad market is if the markets do well, you get a lower rate of return than you would if you just invested in the underlying investments, because you do not get dividends in these things. The banks keep the dividends. It's just straight market performance. And if the markets don't do well, sometimes if they break through the bottom barrier, you lose money anyway. And in other times, you do kind of just get your money back, but you just get your money back in 7 or 8 years. So money doing nothing for 7 or 8 years is not productive money. And once it breaks through the barrier, even if it comes back up at the end, you don't get that return. So I really caution. There's some of them will say there's liquidity on them. There is not any real liquidity, in the sense that it's an artificial market. So if you pay $100 per note, the bank might throw out a junk bid and say, I'll pay you $70 for it or $60 for it. So you take a massive loss if you try to get out prior to maturity. They're also complicated on the tax front. So outside registered plans, they're a mess. So if you see these around, by all means, ask us. I'm happy to tell you what the structure is, what the pros and cons are of it, whether it's one that's worth considering or not. But there are multiple structures. Some of them use derivatives, which was the mess that caused the 2008 and 2009 crisis. So just be very cautious if you see or are contacted from people who are promoting these, because they do tend to come out of the woodwork in these types of volatile markets. Be cautious of those. Again, stick to your plan, stick to your risks. These are great opportunities. We will be talking about this in a year's time and saying how well the portfolios have not only recovered, but how we were able to take advantage of these down markets because of cash in the portfolios. Do sell off the bad assets or anything if you're not in one of our managed portfolios. Do take advantage of this to rejig to areas that are where you want to be in the longer term, because they're going to recover faster. Don't be afraid of selling in a down market if the money is going to be better served somewhere else or recover faster somewhere else. Even if it comes up, I've had people say, "Oh, I shouldn't have sold that at $10. It's now at 12." Yes, but what you bought at $10 is now at 14, so it's worked harder for you somewhere else. So do keep that in mind when you're looking at your portfolios. We have to put these in, but just about generic Canaccord. Really, excuse me. Let's take a look at some Q&A. So there's some questions around the hotels. So the hotels, same, well, a little bit different than the travel, the airline or the cruise lines, but the same. They're going to have a very slow ramp back up again. Again, how quickly are people going to start traveling again? Companies who use a lot of hotel income comes from business travel. And keep in mind, businesses are they're kind of breaking through. Even ourselves, or I'd say 5-6 years ago, my kids would say, "Dad, why do you have to travel for a meeting? Why can't you do it like this or over the phone?" And I was like, "No, you got to do it kind of face to face." Well, people are realizing we can be very effective in this environment. especially with technology advancing, making it so much easier even from home to be able to do these. And of course, you can set these things up as back and forth as opposed to me just talking to a screen, which I assure you is very, very difficult. If you watch some of these late night comedians doing their show with no one laughing and they're telling jokes, it's kind of hard not to be able to read your audience or get feedback. So I do appreciate your patience with me rambling on. But for hotels, how quickly is or how much is the business community even going to jump back to all that travel, and how much is now going to kind of work online more afterwards? We don't know the answers to those yet, but I'd be surprised if it's not a longer road to ramp back up again. And of course, personal travel. Not to mention the cost. You think about these hotels, the clean that they have to do to get things, after the virus is kind of run its course, and they reopen. They're going to have to, sterilize everything and make sure it's safe so there's no new contaminations for people coming in. And if they get one person coming in and gets diagnosed, they've got to do it all again from top to bottom. So I'd be very cautious on the hotel front. It's not something like that I would jump in too early. They're going to have a lot of costs to carry, and probably a slow ramp back up again. Other questions here? Sorry, there's a bunch of comments. I'm just trying to get to the question ones. Shipping. Yeah, that would go to kind of like sea and rail being a recommendation. Yes, as the supply chain is not dead, and obviously when we go to the grocery stores, I saw a report the other day that there was a picture of one day of Costco being completely empty, and the next day all the shelves being full again. So that supply chain is still operating. So some things aren't moving as much. Obviously, oil is not moving as much because the demand has fallen off. But as things ramp back up again, that's one of the first things will have to ramp back up again. So any shipping based investment, I would say, is worthwhile taking a look at. Again, be very cautious on the debt renewal side or debt carry cost, but probably very strong. Okay. You know what? I'm kind of at my time. I'm trying to keep these things between 30 minutes and 45 minutes because I don't want to bore you, and I want to keep everybody up to date. We are going to be doing them weekly, so we'll do another one Tuesday afternoon. Gives us an opportunity to